Welcome back, and we're joined by Rohit Siksaria, Sundaram Mutual, joining us this afternoon to give us a sense of how he's looking at the market. Rohit, thank you so much for waiting by very patiently. Let me first start off by understanding your view on the current market that we are in. We're probably trading at just about sub 18 times 1 year forward, which is FY27. Do you see a risk to earnings, if at all, from the monsoon or any other risks at this point, which should probably keep you circumspect?
No, actually, we are very constructive on markets now. The key narrative about India macro weakness was all related to crude prices going up. Now, with crude coming back down to $70-$75, the entire weakness narrative flips. So we have seen crude coming down. So the worries of inflation going up also comes off to that extent. Even GSEC yields, we have seen already started cooling off. RBI announced this FCNR deposits, so that will take care of the rupee weakness. So in that environment, we are quite constructive on the overall markets. Earnings side, as you mentioned, earnings initially before the start of the year, we were expecting for Nifty something like a 15% kind of earnings growth. There will be some downgrades to that because at least Q1 and to some extent part of Q2 will also face some weakness because of sharp inflation in raw materials which came from the entire oil and petrochemical complex. However, I believe market will look through that because as a one-off temporary weakness, because going ahead from second half, things should come back to normal and market should come back to the same old growth rate.
Triggers be, Rohit, in your opinion, for markets to start to turn towards the normal, which is, I assume, which means that you expect the multiples to trend towards 20, at least on the benchmark.
Yeah, definitely. So that I guess will start happening as earnings starts flowing in. We start hearing from the companies about how long they feel this disruption will last for their earnings. Right now, my belief is Q1 will see lower earnings mainly from lower margins, but from some part of Q2, when the higher cost inventory is drawn down, beyond that, the earnings growth will rebound. Especially the biggest sector in the market, something like your banks and NBFCs, the lenders, they are they are doing very well. We have seen the system credit growth rate of 17% plus recently. So in that environment, the growth should be very good when the results come. Asset quality across all segments, there are no pressures. Even the poorest, like the microfinance segment, is also showing good asset quality. Your NIMs, which were the issue last year, have bottomed out, and valuations in that pocket is still reasonable. So there's room for good re-rating in that segment. So that's one segment which we like, and that's the biggest part of our market. So I believe when the lenders start moving, that's where you will see the markets also move up.
But that will also mean FIs need to come back, Rohit, for lenders to move up, because I believe from a DI standpoint, I mean, they've built the position within the BFSI segment till the neck, right? I mean, you're neck deep in that position. How much more can you build from a position standpoint? So FIs really need to come back then.
Yeah, so that challenge, I'm not sure is going away that quickly because the whole trade for FIs was first developed markets versus emerging markets, and within emerging markets also Korea, Taiwan being favored as positive AI trades versus India. So that's not something which is going away in a hurry. However, somewhere fundamentals will also catch up. So what happens is what we have seen is level of selling by FIs is slowing down, and that itself is good enough to take care of movement in the stocks. If FIs stop selling, that itself will help the stocks move up.
Okay, and what will that trigger be for FIs to come back, Rohit, in your opinion? Because I mean, the way I see it, India has always traded at a substantial premium, but now the global earnings are starting to exceed or accelerate versus Indian earnings, which means that that kind of disincentivizes FIs from really coming back, right?
Perfectly true. So that's where the challenge for FI is why should they come to India today when they are getting higher earnings growth somewhere else? But the key is India's earnings growth has been more secular in nature, while the current earnings which they are getting in, let's say, Korea or Taiwan are more cyclical. So right now they are looking very good, but let's say a year or year and a half down the line, when new capacities come up and some AI capex slows down, you'll see that earnings come off also equally sharply. And that's when you will see really FIs coming back to India. So I'm not expecting FIs to come back to India immediately in a hurry. Only thing I'm expecting is the pace of selling which FIs had so far, that will slow down, earnings growth kicks in.
Got it. Okay. Rohit, sectors, we've spoken a little bit about BFSI as a possible pocket which you need to monitor, and maybe H2 FY27 brings those solid returns. First, I want to try and understand how much within BFSI and banking or lending financials, within the lending pack, will the re-rating be sharp? Will it be 50% thereabouts in terms of the multiples, because you're trading at sub 2 times book on most of the banks? Do they go back above 3 or maybe 2.5 now? How should one look at the re-rating at play?
That's very tough to say, very, very tough to say how the re-rating or how much re-rating these banks can have. But yeah, without FIs coming back and participating in this rally, you won't expect that sub 2 times to go to 3 times, definitely.
Okay, and point taken. And with regard to other sectors or pockets that you're liking, give us a sense.
Sure. So biggest one I said is the lending financials. Beyond that, we like this data center as a story, which we are playing through some power and capital good names. We like hospitals segment within the pharma space. Then there are niche players within the IT segment, like those in advertisement technology or quick commerce, and some auto ancillary players.
And what would the tilt, for example, on auto anch be? Do you prefer a particular pocket, or is there a preference within auto ancillaries as to what you like?
No, auto ancillaries, it becomes more bottom up after that. There are certain companies which are gathering higher wallet share and showing good growth and showing good consistent growth. So we favor those companies.
What about the likes of a Titan and maybe some of the consumer durable names, right? Consumer discretionary, consumer durable. What are you liking within that pack?
So that pack also, we have been positive that pack. Part of that pack has done well also in the current run up. So right now I would be more neutralish in that. But however, there were certain segments within consumer durables which took a hit when crude went up because they had crude as a raw material. That part of the consumer discretionary pack can see a bounce back with crude coming off.
Okay. Rohit, thank you so much for joining us. Gives us a sense as to what you're liking and how you're looking at the markets. Thanks so much.
Thank you.
All right. Let me